Let's run a quick number. You have $10,000 sitting in a traditional savings account, earning the national average of 0.39% APY. That earns you about $39 a year. Meanwhile, real-world emergency costs, an ER visit, a car repair, a plumbing emergency, are rising between 6 and 8% annually. Do that math, and your safety net is losing ground every single month. The problem isn't that you saved. The problem is where you saved it. Today, I'm going to show you a smarter framework, one that keeps your money liquid, keeps it safe, and actually preserves its purchasing power. Welcome to Finance Deconstructed, where we don't just tell you what to do with your money, we show you exactly why. I'm going to break this down layer by layer, so by the time this video ends, you're not just going to know what to change, you're going to understand the mechanics behind it well enough to explain it to someone else. Let's get into it. Let me start with a concept that most personal finance content completely glosses over: the velocity of money. In economics, the velocity of money refers to how frequently a dollar changes hands within the economy over a given period. According to Federal Reserve data tracked by the St. Louis Fed, the velocity of M2 money stock, which measures the money supply inclusive of savings and checking deposits, hit a record low of 1.13 in April 2020 during the pandemic. As of late 2025, that figure has climbed back to approximately 1.41. What that recovery tells us is that money is moving faster through the economy again. Transactions are happening more frequently. And when money moves faster, prices tend to adjust faster too. Now here's why that matters directly to your emergency fund. The traditional emergency fund model was built on a relatively stable economic assumption that prices moved gradually, that you'd have time to adjust, and that a savings account, even a low-yield one, would roughly hold its value over the short to medium term. That assumption no longer holds in the same way. Supply chain disruptions post-2020, rapid technological shifts, and geopolitical instability have created what economists call unpredictable price spikes in essential categories. These are the exact categories your emergency fund exists to cover: car repairs, medical bills, home maintenance, short-term housing costs. And here's where the Consumer Price Index, or CPI, becomes a critical piece of the puzzle, and also a major source of confusion. The CPI is how the government officially measures inflation, but financial experts and economists have noted for years that it significantly lags behind what consumers actually experience in real time, particularly in medical care and emergency repair categories. Here's a concrete example. The CPI for medical care services showed a 3.0% annual increase as of mid-2024. Sounds manageable, but research from the Center for Economic and Policy Research tells a different story. When economists summed up actual out-of-pocket consumer spending, co-pays, deductibles, direct payments, and family-paid premiums, total healthcare spending for families came in at nearly $4,000 per year in 2024, rising at a rate of more than 7% annually over the previous 3 years. That is more than double what the official CPI figure suggests. The BDO healthcare analysis puts it plainly. There is a growing and meaningful gap between what the CPI tracks and what consumers actually pay. ACA marketplace insurers raised premiums by approximately 20% for 2026. Meanwhile, the medical CPI reported inflation of 3.0%. These two numbers are not describing the same reality. This lag matters because your emergency fund is denominated in dollars, and those dollars buy less of exactly the things you're saving them for faster than the official data suggests. Add to this the final layer of the velocity problem. In a high-velocity economic environment, the cost of living adjusts faster than bank interest rates respond. When the Fed raises rates, savings account yields do follow, but with a lag and unevenly across institutions. When the Fed cuts rates, savings account yields fall quickly, often faster than inflation cools. This asymmetry leaves savers in a perpetual catch-up position. Your money sits still. The cost of your emergencies does not. Now let's talk about the opportunity cost of leaving your money idle. As of February 2026, the national average interest rate on a traditional savings account is 0.39% APY, according to the FDIC. That is not a misprint. The average American keeping their emergency fund in a standard savings account earns less than 0.5% per year. With inflation running around 3% year over year as of late 2025, a traditional savings account delivers a real inflation-adjusted return of approximately negative 2.6%. You are not just treading water, you are slowly moving backward. Now multiply that by 3 years of a 6-month emergency fund, say $20,000, sitting in a traditional account. At 0.39%, you earn about $78 per year. Inflation at 3% erodes roughly $600 of purchasing power from that same $20,000 annually. The net loss in purchasing power over 3 years approaches $1,500. That is money you do not get back simply by staying disciplined. The wealth destruction compounds when you compare this to what's been readily available. High-yield savings accounts offered by online banks have been paying upwards of 4% APY through 2025 into early 2026, according to bank rate data. Treasury bills, short-term U.S. government securities with maturities of 4 to 52 weeks, were yielding between 4.17% and 4.33% through early 2026 at various durations. On that same $20,000, a 4% yield generates $800 per year rather than $78. The difference is $722 annually. Over 3 years, that's over $2,000 in foregone interest. This is not about chasing returns. This is about not unnecessarily surrendering value that was available to you all along. The philosophical shift required here is an important one. The old framework treated your emergency fund as a vault, a sealed container that held value by definition, simply because it existed. The modern framework treats it as a working reserve. The money is still safe, it is still accessible, but it is actively working to preserve its own purchasing power rather than passively losing it. And here is an important nuance that finance experts always flag. Your emergency fund should not be in the stock market. Equities can lose 20, 30, even 40% in a market downturn, precisely the kind of economic shock that might also cause you to lose your job and need your emergency fund. The goal of a working reserve is not high returns. It is positive real returns, meaning returns that outpace inflation while maintaining full safety and accessibility. So what does a modern emergency reserve actually look like? Let me give you the specific blueprint. The answer is tiering, splitting your emergency fund into layers based on when you'd need to access them, and placing each layer in the instrument best suited to that time horizon. Tier 1 is your immediate access layer. This covers roughly 1 month of essential expenses and needs to be available within 24 hours, no questions asked. The right instrument here is a high-yield savings account at an FDIC-insured online bank or a money market account. As of early 2026, leading high-yield savings accounts at online institutions are offering rates of 4% APY and above, well above the national average and outpacing the current inflation rate. Vanguard's money market funds, for example, maintain a stable $1 net asset value and carry expense ratios between 0.07% and 0.12%. These are genuinely liquid and genuinely competitive. Tier 2 covers 2 to 3 months of expenses and is the next layer of liquidity, accessible within 2 to 3 business days. This is the appropriate home for Treasury money market funds or short-term certificates of deposit with no heavy early withdrawal penalties. Short-term T-bills in this range are currently yielding in the low to mid 4% range. An added advantage, interest income from Treasury securities is exempt from state and local income taxes, which can meaningfully improve your after-tax return if you live in a high-tax state. Tier 3 is your strategic reserve, the portion you'd only access in a prolonged emergency like extended unemployment. This can sit in slightly less liquid but higher-yielding instruments. Series I savings bonds from the U.S. Treasury are a particularly well-regarded option here. I bonds pay a composite rate tied directly to CPI inflation, meaning they're explicitly designed to preserve purchasing power. The trade-offs: you cannot redeem them in the first 12 months, and if you redeem before 5 years, you forfeit 3 months of interest. You are limited to $10,000 in electronic I bonds per year. But for a long-duration emergency reserve that you genuinely would not need immediately, they are one of the few instruments the government has designed specifically to protect you from inflation. A CD ladder, staggered maturities of 3, 6, 9, and 12 months, is another practical option in this tier, allowing you to always have a CD coming due in the near term. Here is a quick checklist for selecting instruments across all 3 tiers. First, confirm FDIC or NCUA insurance for any bank-held product up to $250,000 or SIPC coverage for brokerage-held money market funds. Second, verify liquidity. How quickly can you actually access the funds, and are there any penalties? Third, confirm the yield is competitive relative to the current inflation rate. Fourth, factor in taxes. Treasury products exempt from state tax may outperform on an after-tax basis, even if their headline rate is lower. Fifth, match the tier to your actual risk profile and household situation. A freelancer with variable income needs a larger immediate access tier than a dual-income household with stable employment. Let's talk about how to transition and future-proof what you have. The good news: moving from a stagnant cash position to a tiered reserve system does not require taking on additional risk. It requires changing where the money sits, not what you do with it. The practical migration plan looks like this. Start by identifying your full emergency fund balance and your monthly essential expenses. Define what 3 to 6 months looks like in dollars for your household. Then leave 1 month's worth of expenses in your current savings account or move it to a high-yield savings account immediately. This becomes your Tier 1. Take the next 2 to 3 months' worth and open a Treasury money market fund through a brokerage account like Vanguard, Fidelity, or Schwab. These accounts can typically be set up within a few days, and fund transfers can take 2 to 5 business days. Then, if your emergency fund is larger than 4 months of expenses, evaluate whether a CD ladder or I bond position makes sense for the remaining balance. One habit that finance professionals recommend building into this system is what you might call a purchasing power audit. This is a simple quarterly or biannual check where you compare the yield your emergency fund is earning against the current inflation rate. If your yield falls below the inflation rate, your reserve is losing purchasing power, and you should shop for better instruments. This is not complicated. It takes 30 minutes twice a year, but it is the difference between a saving strategy that is static and one that adapts to economic reality. The broader implication of this approach is significant. When your emergency fund is positioned correctly, it stops being a pure liability, money you park and forget that slowly erodes, and becomes a resilient pillar of your financial foundation. It still protects you in a crisis, but it also preserves its own value between crises. That is the distinction between a passive savings mentality and an active reserve mentality. Here's what a finance-literate person sees when they look at this problem clearly. The emergency fund advice most people received, 3 to 6 months in a savings account, full stop, was never wrong, but it was never complete either. It addressed liquidity and safety without addressing purchasing power preservation. In a low-inflation, low-volatility environment, that gap was inconsequential. In an environment where CPI is running at 3%, medical costs are rising faster than that, ACA premiums are jumping 20% in a year, and the national average savings rate is 0.39%, that gap is real money, real erosion, real risk to the security you worked to build. The velocity of this economy demands that your reserve moves with it. Not by taking on risk, but by being intentional about where your money sits and making sure it earns enough to still be worth what you need it to be worth when you need it most. That's the framework. That's how you future-proof your liquidity. If this video changed how you think about your emergency fund, even slightly, that's exactly what Finance Deconstructed exists to do. Most financial content tells you what. We go deeper and tell you why. Because when you understand the why, you make better decisions with your money long after the video ends. If that's the kind of channel you want in your corner, subscribe. We break down the concepts the mainstream skips over, the ones that actually move the needle on your financial life. And if you know someone whose money is sitting in a savings account right now doing nothing, share this video with them. It might be the most valuable thing they watch this year.